Wow, if you were watching the East Asian markets today, you know it was an absolute bloodbath, especially in Korea. So the big question is, what just happened? In the next few minutes, we're going to break down exactly what went down today in Korea, Hong Kong, and China. We'll look at what triggered this whole thing and what the data tells us might happen next. All right, let's dive in.
3.86%. I mean, that's the number that just sent shockwaves through the Korean market. The KSBI took an absolute nosedive today. And what's really crazy, this happened just one day, after it hit a brand new all-time high. A swing like that, it really makes you stop and think.
And that's really the million-dollar question we're tackling here, right? Was today just a healthy correction? You know, the market letting off a little steam after getting way too hot? Or is this the first sign of something much bigger, a real downturn? That's what we're going to figure out.
Okay, so here's how we're going to break it all down. First, we'll look at today's numbers. Then, we'll dig into the global reasons why this happened. We'll touch on a few theories to explain the chaos, look at what the data predicts, and finish with some key takeaways for investors.
All right, first things first. Let's just look at the raw numbers from today, February 5th. And yeah, it was a rough one for Korea.
So, the main index, the KOSPI, closed down almost 4%. And it wasn't just the big guys. The KOSDAQ, which is full of tech stocks, also got hammered, dropping over 3.5%. Look, this wasn't just a small dip. This was a massive across-the-board sell-off. So you gotta ask, what on earth was the trigger?
Well, the thing is, what happened in Korea today didn't just come out of nowhere. Think of it like a series of dominoes. And the first one to fall was actually on the other side of the planet, in the US.
It all started with the NASDAQ. For 2 days, it was sliding because of this growing feeling that AI stocks had just gotten way too expensive. That nervousness, it spread like wildfire. And as soon as Asian markets opened their doors, that wave of selling sentiment just came crashing in. And that ripple, in Korea, it turned into an absolute tidal wave. Get this. Foreign and institutional investors dumped a jaw-dropping 7 trillion won of Korean stocks in one day. To really put that into context, foreign investors by themselves sold almost 5 trillion won. That is a new record for a single-day sell-off. Now, retail investors, regular folks, they tried to buy the dip, but there was just no stopping that kind of selling pressure.
So what threw gasoline on the fire? The currency market. You had the U.S. Treasury Secretary talking up a strong dollar, and some tension in the Middle East, and boom, the won-dollar exchange rate shot up. When the won gets weaker like that, it suddenly makes Korean stocks look less valuable to foreign investors, so it gave them yet another reason to hit the sell button and get out.
But here's where it gets interesting. While Korea was in a free fall, the story over in Greater China was totally different. Hong Kong actually ended the day up a bit. Investors there were feeling optimistic about some new policies. Mainland China, on the other hand, kind of followed Korea's lead and went down, mostly because of some bad manufacturing numbers and ongoing worries about the property market. It's a great reminder that even when there's a global trend, local issues can still change the game completely.
Okay, so we've covered the what and the why of today's drop. Now let's put on our analyst hats for a second and look at a couple of economic theories that can help us make sense of all this chaos.
First, there's this classic idea of an overheat and correction. Think of it like an engine running in the red for too long. Eventually, it has to cool down. The KOSPI hitting a record high just yesterday, and then this huge drop today. I mean, that is a textbook case. This theory suggests today wasn't a sign of a broken engine, just a necessary cool down.
Then you've got crowd psychology. The idea here is that markets aren't always rational. A lot of the time, they're driven by emotion, like a herd of animals. And today was a perfect example. You had a few huge investors start selling, and that created this wave of panic. It's like everyone else saw them running for the exit and just instinctively ran along with them.
And last up, there's this thing called volatility clustering. Basically, it means that wild days in the market are rarely a one-off. Big swings tend to be followed by, well, more big swings. So a massive drop like today's is a pretty strong signal that we've entered one of these clusters. It's a heads up that we should probably brace for a bumpy ride in the near future.
So, knowing that things could stay choppy for a bit, what's next? Let's take a look at what a data-driven forecast says about the rest of the month. And just to be super clear, this is a computer simulation based on past data. It's not a guarantee, just a projection.
The method behind this is pretty complex, but here's the simple version. We basically had a computer run 1,000 different what-if scenarios for the market over the next few weeks, all based on how it's behaved in the past. What you're about to see is the average of all those simulations.
And here's what it came up with. Now, after a day like today, this might be a little surprising. The model actually projects a modest recovery for everyone by the end of February. It sees both the Kospi and Kosdaq bouncing back about 1.5%, and it shows small gains for Hong Kong and Shanghai too. So according to the data, this looks more like a sharp dip than the start of a long slide.
Okay, so what do you do with all this information? For our last section, let's talk about some key things to watch for as you navigate this kind of market. Now, obviously, this isn't financial advice, but it is a look at what the experts are keeping an eye on right now.
First, keep an eye out for signs that the selling is exhausted. There are technical indicators that are now flashing oversold, which historically means a bounce could be on the horizon. Second, you gotta follow the money. Right now, the data clearly shows money is flowing out of the market. You'll want to watch for that flow to slow down, stop, or even reverse. And third, think about diversification. The AI and semiconductor stocks that led the crazy rally are the same ones leading the drop. It might be a time when more stable, domestic-focused companies offer a bit more, well, stability.
And really, that brings us right back to where we started. This quote sums it up perfectly. As scary as a day like today can be, the consensus seems to be that this wasn't the system breaking, it was more like a needed reality check after the market got a little too carried away with all the AI excitement. So, let's leave you with this final thought. The data points to a recovery, but the theories tell us the ride is probably going to be bumpy. The real question for any investor isn't just how do I survive this, but where are the opportunities? In all the volatility that's coming, where will you be looking? Thanks so much for tuning in.